Another closed week. Welcome to Global Wealth KPI for week after week market update, November 30, 2020 to December 4, 2020. Stocks edged higher a week ago as the market's noteworthy meeting stretched out to the primary 7-day stretch of December. In spite of an outstanding stoppage in employing that was uncovered in the November occupations report, major lists shut at record highs and Treasury yields rose, reflecting desires for extra financial upgrade. The U.S. economy added 245,000 positions in November, missing evaluations in the midst of a spike in COVID-19 contaminations and recharge limitations in movement. The joblessness rate declined to 6.7% from 6.9%, however the investment rate likewise declined, demonstrating that more individuals left the workforce. The silver covering is that the downshift in employment gains could apply strain to administrators to agree for another upgrade bundle before the year's end. Oil stretched out its benefits to a 9-month high after OPEC and its partners consented to expand creation more step by step than recently arranged, and the dollar hit another over long-term low against significant monetary standards. What comes next? Markets added to year-to-date picks up a week ago, with the spotlight focused on the magistrate of 1. Immunization progress, 2. The present status of the economy, and 3. The potential for a monetary bundle in Washington to overcome any barrier somewhere in the range of 1 and 2. Our brisk interpretation of each. Immunization trusts. The mass circulation of an antibody at some point 1 year from now speaks to an articulation point for the recuperation, permitting financial movement to revisitation of more ordinary levels. Markets have properly centered around the post-antibody recuperation as of late, supporting the 13% addition in the S&P 500 since the beginning of November. The economy, while the forthcoming antibodies firm the viewpoint for development 1 year from now, current conditions are indicating the headwinds made by flooding COVID-19 cases and the subsequent closures across numerous districts of the nation and the created world. Retail spending, fabricating action and the work market are on the whole displaying versatility yet additionally indications of stress. We anticipate that the bounce back should slow down fairly in the coming a very long time prior to recapturing energy 1 year from now. Monetary boost. Negotiations in Congress over a new round of financial guide gave faint indications of progress a week ago. However, a prompt arrangement is a long way from guaranteed, as Democrats and Republicans stay separated on the size and focuses of another guide bundle. We presume that the more extensive spending arrangements in coming days will incorporate gradual financial alleviation measures, yet a more exhaustive arrangement may not completely arise until right on time 1 year from now. With the possibilities of an antibody improving, monetary upgrade will be significant in crossing over the monetary hole for family units and independent companies until the economy is all the more completely resumed 1 year from now. What comes next? A week ago brought the most recent positions report, the turn of the schedule to December, and new highs for the financial exchange. These aren't basic impetuses for the market, yet they do offer an occasion to assess execution. Utilizing the past as a guide, here's generally what's come straight away. Sub 7% joblessness. The November occupations report delivered a week ago demonstrated that the U.S. economy added 245,000 positions a month ago, dropping the joblessness rate to 6.7%. On one hand, it's uplifting news that work creation keeps on being positive, with this denoting the 7th continuous month of employing gains adding up to 12.3 million. Then again, the pace of occupation development has eased back seriously in the midst of recharged cases and limitations. All the more comprehensively, the joblessness rate has arrived at the most reduced level since the pandemic started, tumbling from 14.7% in April to underneath 7% in November. This is empowering improvement. However, 6.7% joblessness is still verifiably high and a decent token of exactly how much harm the pandemic has delivered on the work market. The uplifting news. The joblessness rate has punctured the 7% imprint in a descending, improving heading multiple times since 1945. By and large, the joblessness rate was 5.8%. Gross domestic product development found the middle value of 5.8% during that time, counting 2.9% in the year following the 2013 dip under 7%, supporting the case for a continued, solid, and expansionary monetary stage ahead. 1. Energy heading into December. Stocks take their heading from monetary, income and strategy essentials, not the schedule. All things considered, December has verifiably been a positive month for the market, with a normal month-to-month gain of 1.6%. 1. The uplifting news. When the financial exchange enters December on a positive note, that force has regularly been helped through the rest of the year. In the course of recent years, when stocks have begun the last month of the year with a year-to-date gain of 10% or more, just like the case this year, the market posted a positive addition for December 82% of the time. What's more, the market rose by a normal of 7.8% over the accompanying year. 1. Recuperating to record highs. Stocks have now recovered the bear market misfortunes from recently, arriving at another record a week ago. With values up over 60% since late March, this has been the quickest recuperation from a 30% in addition to showcase drop on record. Markets don't go in an orderly fashion uncertainly, and keeping in mind that we think 2021 will be a positive year for the business sectors, we expect the way forward to be bumpier than the one we've gone in the course of recent months. The uplifting news. Recovering the misfortunes from a bear market didn't check a fatigue point for stocks. Glancing back at the bear market since World War II, when the market got back to the past high, the market picked up a normal of 14.3% over the accompanying year. 1.